Hey guys, it's Max Convexity. Welcome back to the channel. I like to talk about option strategy ETFs, mainly defining its yield max, but also curve, but also option strategies kind of generally. And I also like to talk about using options in retirement. So I started a series about a month ago. It was actually on July 10th, and it was how to use options in retirement seriously. That was the name of the series. Well, anyway, one of the ways you can do it, and back in July 10th, the market was up and it was close to a top, and I was saying the market was going to sell off. So I was showing one way you could do it is if you had $1 million portfolio, let's say. Well, the market was up about 20% year to date. So your $1 million portfolio would have been up about 200,000. So, and that was on July 10th was the scenario. So, how could you use options to hedge that for the rest of the year if you're bearish on the rest of the year, kind of like I am, or at least cautious? Well, anyway, so let's take a look at that trade. I called it the $1 million baby trade, or I called it New Year's baby, or the $1 million baby. I mixed up my idioms or my metaphors. Okay, so. But today the market's selling off, so it's a good time to look at it and to talk about it. All right, so here was July 10th at 11 o'clock. There's a whole video on it as well, too. And I also, on that same video, I made different versions of the same trade. And you can see they're up 48,000. But anyway, the $1 million, this hedge is a $1 million account. It's get out of jail free for $1 million account. So let me just show you real quick what it is. This isn't the only way to hedge, or even maybe the best way to hedge. It's just a way to hedge. But here's the profit and loss graph of the. Here's the profit and loss graph. What it is, it's a 7 by 5 put spread for New Year's Eve. In any event, I programmed it, or I made it to exactly offset the drop in $1 million account. All right. So far it's done that, because let's check that. Let's audit that really quick. So it was an SPX hedge. July 10th was the date. So July 10th was right. There it is, July 10th. This was at 11 o'clock in the morning. We can even go for that. There we go. So the price was at 56.12. Now the price is at, we're going to call that 5,600. This one's at 53.15. So we'll call this one 5,300. Okay. So really, let's just figure it out. It's 6%, right? Okay. So it's 6% down. So your $1 million account should be down $60,000 about. Now let's look at the trade. The trade right now is showing a plus 48. If the selling picks up, it's designed to offset it, especially at the higher levels. Check this out. If the selling picks up, one thing, if the selling picks up, the trade has convexity, not max convexity, but it does have some decent amount of convexity, because what will happen is if the selling picks up, so will the IV, and the IV that'll make the trade worth a little more. So the IV jumps, 5 or 10%, and this falls another 10% from here, and it's already down 6%, or another 20% from here, and it's already down 6%. So that means 26% total. So it would need to be up 260,000 to offset that, and it would be up 285. That's on September 21st. If it does it right away, it would be up. It'd be up 277. So it's right on the money. It's a total offset. It's a get out of jail free card. You don't even have to sell it. You can just leave it open. If the market keeps selling off, it'll keep offsetting your loss. If the market rallies again, well, that's fine too. The market rallies, you'll be out to $34,000, but I mean that would be fine with me too. Either one would be fine. But on New Year's Eve, wherever it is, you have to, if it is in the money, let's say we're still down 10% on New Year's Eve, you're going to have to, well, let's roll it forward to New Year's Eve. If it's down 10% on New Year's Eve, this trade would be up about 224,000. So it'd be enough to pay some taxes as well too. And you would have a tax bill. You would have a $224,000 capital gain, or well, 224 less the 32 you spent on it. So anyway, $190,000 capital gain, but it'd be a good problem to have, right? And at least your account, because your growth account would not be worth $1 million anymore. It'd be worth more like 900,000. So this little extra money in your options account would damn sure help. Okay, so let's say you didn't listen to me and you missed that trade. All right, well, is it too late to do it? Well, I don't know. Let's look. So I just did one like 10 minutes ago, and it's already up $2,000. It takes a while to jack with the strikes and everything, so I didn't want to waste your time. But this one right here is a 5x3 put spread for New Year's Eve. Okay, but it's the same thing. So it's the same thing. If we drop 5% from here, and right away, let's say by Monday, and we may drop another 5. I mean, right now, the way we're dropping right now, we're down 3.9 right now on the NASDAQ. Is that right? You got to be kidding me. This NASDAQ's in a free fall. Well, no, I'm sorry, 2.8 in the NASDAQ. We were down 3% earlier. We're down like 5% for 2 days. Anyway, if we drop another 5% by Monday, God forbid, I'm not trying to jinx this, and you put this option position on, you'd be up $32,000 on this option position, even though you'd be down about 50,000 on your stock position. But if it dropped 10%, then you'd be all right. Well, no, not quite. 71,000. If it dropped 20%, let's see, 176,000. So this is actually a little bit of under. If it drops fast, it's a little bit of what's the word? Under hedged. But the thing is, as time goes by, because you aren't, time goes by. Let's say we get into October and it's still there, then it's a full offset. And God forbid if it's still there in December and you have to realize the gain, it's a full offset. So, okay, but that's the good news. So this is the new one. And you could do this one. I'll send the link to this trade. You can do this one yourself. That's the good news. The bad news is it costs $46,000 to put on. So if you have this is for $1 million account. So if you have a different size account and you want me to help you, send me your particulars. I love to do what ifs like this, but this is for $1 million account. Okay. Now these options are cash settled. And even though you're paying a lot of time decay, you're also selling. It's part of a spread. So you're selling these 4900s, and the depreciation from these is helping finance the options that you're long. But in any event, I'll post the link to this. But yeah, so it costs think about it in percent. To insure now it costs 4.6%, whereas before it cost 3.2%. 3 weeks ago. Well, what's changed? Well, the market's dropped and everyone's realized that, oh shit, this market's, shit. So the thing is, maybe the drop's over now. You never know. I mean, the big drop that I'm forecasting for may not materialize. This could be about be it, and it could bounce from here, and who knows. But the problem is, it's just like buying hurricane insurance for your house, 6 months before hurricane season. You're going to get a better rate than like 2 weeks before with like a hurricane, like 3 hurricanes in the Gulf headed your way. I've never bought hurricane insurance, but you get my example in theory. So that's the problem. If you wait till next week, it might even cost more. But hedging is not always the right answer. It might be the right answer not to spend this $46,000, because maybe the market really for the rest of the year kind of chops and doesn't really go anywhere. Well, you'd be out 46,000 if you did it this way. And, maybe the drop's already in, so maybe it's too late. I don't know. I'm not telling you what to do. I just like to talk about what ifs, but like I say, I'll post the link to that if you guys want want to do that in your own account. I wish someone would have done that the first time, but no one's told me they did it. Oh my gosh. Cause I was, anyway, I was just, the market was too good for too long. And I just had a feeling I think the high for the year is in. And, you know, I mean, I know it's only July, but anyway, I missed it by a couple of days. If you look at July 10th, it was right here when I said that. It was actually went a little bit higher in July 16th, but then from there it's been straight down. But yeah, from now, maybe it's pulled back all it's going to pull back, and maybe this is all we're going to get. So I don't know. In any event, I wanted to show I love hedge trades, and with the election coming up, in case something crazy happens, you know, on a geopolitical basis also, I figured it'd be a good time to have puts between now and the end of the year. So I think it might help somebody sleep at night. If you had $1 million portfolio and you've had it, the idea is you didn't just buy it, that you've had it for at least a year. Well, if you've had $1 million portfolio for a year, even if it's a 60-40 portfolio, you're up to 150,000 because it's been a great year. If you've had it for 2 years, you're up 300,000, okay, or something like that. Even on a 60-40 portfolio, in my scenario in the video, it was a guy that was like all in growth, and he was like, "Oh my gosh, I'm doing so well. I'm all in growth. What should I do?" Because somebody that's all in growth was up more like 25%. So that would have been about 250,000. So spending 32,000 to protect 250 for 7 months also doesn't seem like that, or 6 months doesn't seem like that much to me. But yeah, 46,000, it's kind of expensive now. All right, so since we're talking about options, let's look at some of these earnings trades real quick. All right, so these are the earnings trades for next week. Lilly, CVS, that one's for next week. Robinhood, that's for next week. Okay, but everything from here down is for this week. All right, so here's this Apple trade. It's up $259. That was a great trade. Oh, yeah, Disney's for next week also. I'm sorry. Anyway, if you guys like any of these kinds of trades, let me show you an example of one of these real quick. Or let's see how he did today. I did some content on the Apple trade and the META trade. And Apple made $200-300. META made $1,400. Let's look at Apple. Okay, and I want to explain kind of how it works. These trades are awesome. See, it appears like there's no place you could lose. But what this trade did, or what you're always trying to do, these are what's called a double diagonal. Anything below the line are short options. So that's a 230 call and a 215 put. So those are both sold. They're short. Anything above the line is bought. So that's a 225 call and a 217.5 put. So what does all that mean? So if you just exclude the options above the line, here's what you're trying to do. You just are really trying to monetize this money. These options expire this week, and Apple has earnings this week. So as soon as the earnings are announced, the volatility should collapse. And since you're short the options, you want the volatility to collapse. But anyway, all right. So, and sure enough, that's what's happened. But that's called just a strangle. That's where you short options, but your loss is theoretically unlimited. We can't see it because I don't know why. But your loss is unlimited on both sides. Okay, so what you do when you do a double diagonal is you have the long trades back here. We're going to include. Okay, well, let me show you just the long trades. So just the long trades is like the opposite trade. It makes unlimited money going both ways. Okay. Whereas the short trades are the opposite. If the market doesn't go, it makes money. So what you're trying to do, what I'm doing when I'm putting these together, is I'm putting together in a strategic way where the short legs pay for the long legs, and then I readjust how far I put the legs apart to reallocate where the risk is in the equation. If I don't want any bullish risk, like on Meta, I thought, or on Apple, all of these tech ones, I wanted no risk to the upside, so I can make that happen. But you can also make no risk to the downside. I did that on the Lilly trade for next week, just in case Eli Lilly misses earnings. I'll show you that one next. But in any event, these are pretty slick trades because it's just two options that have a profit and loss graph like this. They make money in the middle and lose unlimited both ways. Then another ones that make money in the middle or that lose money in the middle, but then make unlimited on the wings. And it's the pairing of them. And they're some of the most fascinating trades out there. And it's you can call it a double diagonal, a straddle strangle swap. And these aren't even ratio diagonals. Ratio diagonals are related, but they're like the wild cousin. We aren't even going to talk about those today. But these are just a double diagonal and just a real easy income trade. So in any event, that's the profit and loss graph at expiration. Here's the profit and loss graph now. You can see that even as time passes between now and the end of the day, this trade's about maxed out on what it could do. So you sold the 215 and you sold the 230, right? So without even thinking about the hedge, you just want the price to be between 215 and 230 and you'll make money. Sure enough, this trade was a winner. So that's the way these trades are designed to work. Now here's on META, here's what happened when it goes really right. The META trade, META hit their trade and the price moved up quite a bit. So in any event, this trade was basically aiming for between 472 and 490, right? META's price ended up at 487. But these are designed where even if it overshoots, because these tech stocks do, there's still plenty of money on the upside. They just can't undershoot. Okay, so and you can see right here the time passing, but this trade's about maxed out. In real life, you would have already got rid of this morning. I mean, it's up $1,200 this morning, but we're just paper trading it to see. All right, I do have the Apple one on in real life. I have a similar one. I had, I don't have it exactly on here. All right, well, now let's look for next week. Next week here, we'll look at this Eli Lilly one. Now this is a bearish Eli Lilly one. This is an interesting trade. So all we're asking this to do on this trade is for Eli Lilly after earnings not to go up by more than 14%. So this is if you think it's going to miss earnings. And if it stays where it is, ideally it'll come in here and that'd be great if it just stayed where it was. But even if they miss earnings and it goes down 20%, still a $1,300 winner, but it's on $8,000 worth of risk. This is a more expensive trade. I was just trying to show some interesting things you could do. It's more expensive to protect these on the downside because there's call skew and put skew, and most of these stocks have call skew, which means calls are more expensive. So strategies involving selling calls, you can sell calls for less, but which is generally what we're doing when we're hedging the upside. But when we're going for a down one, it's more expensive, a down move generally. All right, so but yeah, that trade's up $267 right now. So yeah, here's a bullish Eli Lilly trade. Here's the same trade, but the bullish version of it. So, and Lilly's earnings isn't until next week. So we're just waiting we also need time to pass. Okay, I'm just showing you guys these. We'll see how these do next week. I think Lilly reports on Thursday. Here's one on CVS. This is a pretty standard, easy to understand one. Here's the profit and loss graph at expiration. This is a cheap one to put on as well. You could put this one on for $80. All you're asking CVS to do is not to drop by more than 7%. You're just wanting time to pass them to announce earnings. And you know, even if it goes up by 20%, you still make a little something. But ideally, you want it to go up no more than 10% and down no more than 7%, and you should do just fine. So these kinds of trades are like getting up in baseball and hitting for singles. All right, so Robinhood, similar thing, sold the 19 and the 21 call, expires next Friday, buying the 19 and the 20 put and call that expires the week behind that, just to hedge it. The options you buy are just to keep you from having unlimited loss and just to make the trade affordable for the small guy. Diagonals are great trades for retail because you can't really lose that much. They don't all, I mean, there's times you should, doesn't mean you should always do them. There's all kinds of times you shouldn't do them. But anyway, I think these double diagonals work really well for earnings trades. Okay, well, there's the Robinhood trade. So you can see on this one, you know, Robinhood was higher yesterday. It couldn't drop more than like 5% between earnings, but it's already dropped a couple percent, and that happens sometimes. So anyway, that's the way it goes. All right, so let's do this really quick. Let's look at the earnings calendar. So here's for next Thursday. So Lilly, Brookfield. I'm trying to find one. What about Gilead? Or AKAM? I don't know how you say that, AKAM. I want to show you guys one from start to finish. Let's see. Ideally, you don't want the little explanation points in the box. That just means that option has a wide bid-ask spread. It can still simulate it, but it means it's not the best. So I try to choose ones that don't have that. And then if I get one that does have that, I just make sure I get the worst price. See, we're selling these options. So when you're selling something, you get the lower price. And when you're buying it, you know, it being retail. But if I was buying this option, I'd pay the higher price, right? So if you sell it, you sell the bid. So it'd be 49 cents. So I'll switch that just to make it more realistic. In any event, okay, so here's one for Gilead. I mean, I don't just love that one because there's not a lot of cushion. Gilead can only drop 1.6%, and this turns into a loser. And I don't like that one. Some of them don't work out. So that one's no good. At least I didn't think so. What was it? Okay, AKAM. I want to show you guys how to do one of these. All right, so let's try this one and see if we can make some kind of, the thing that's cool about option strat, and you guys need to get it if you don't have it, is I need to become a sponsor or whatever. I need to start pimping it out or selling it. It's actually good modeling software just to model stuff out. Okay, so all right, so here, however you say this one, AKAM. So it looks like a person could do this depending on the fills, but I'm not going to jack with those yet. But this, just by eyeballing it, it looks somewhat attractive. It's about a 5% cushion. I mean, if it drops more than 5%, you don't deserve to make money. That's why these are in theory 2 out of 3 winning trades. These because you're selling options, but even though you're selling options, you're using a trick to make it where you don't lose unlimited. And not only that, where you don't lose anything on one side. Because you know this stock could be like META and be up 20%. It could also be like Intel and be down, 10%. But your advantage is the 5% built in. So this one looks pretty good. We'll just hit save, and we'll check in on that one next week. All right, so let's check these $1 million babies out and check the market out. $47,000 on the one for December. Okay, so let's see what's happening. Oh, it's bouncing. S&P's bouncing. These are 30-minute bars. We'll see if this lower high can hold, or because that's a lower high, and see if they can start something. But even if they start something, they need to fill this gap. That's the first thing they need to do, is fill this gap without failing and turning around and dropping, which is, if they do get up into this gap, probably what they're going to do, turn around and fail. And like I said, I haven't been bullish on this market, and I've been right so far. But even if they do get back up towards the top of this range, maybe they'll fail again like they did up here. A lot of people thought after this day, okay, well, the pullback's over. Well, it wasn't. And maybe it is now, though. I mean, I don't know. The average right here is a 200 period moving average, just FYI. All right, well, let's see how the $1 million baby that I did today, it's probably losing money now that the market's bouncing. And it still says it's up $1,700, but who knows? Here's the profit and loss graph on it Monday, Tuesday. Basically, you can see over a short time frame, it's just like in short stock. You don't really pay time decay, over the course of a week or something. But over the course of the trade, yeah, if it doesn't move, between now and New Year's, you're going to lose $46,000, and you're going to pay all kinds of time decay. But I cushioned it where you pay as little, because you're also earning some time decay. So the theta on this is negative 59. The theta on this is positive 61. So you're earning $61 a day on your short position, which is offsetting the theta that you're spending on your long position, in theory anyway. And that's just for the next day. I know those don't always hold over time, or they don't hold over time. But that's the whole idea of this trade, is you're aggressively short, but you aren't going to bleed to death like you would if you just bought a call and you didn't. I'm sorry, like you would if you just bought a put and you didn't sell another put somewhere else. So anyway, all right, that's the way I like to do it. Like I said, I know there's better ways to do it, or I assume there's better ways to do it. But I know there's better ways to do it. So anyway, if you have one, tell me, because I'd love to know. I love studying this kind of stuff. Anyway, if you have a different size account, or if maybe you're in small stocks or you're in value stocks, you could do a hedge on the Russell instead, or there's all kinds of possibilities once you learn how to use options in retirement. And this is an example that I was trying to show you. And this isn't for YOLO purposes. This is like, hey, I'm up $250,000 this, in the past year and a half, and I don't want to lose it because of, because the market sells off, because of our crazy politics, or because of all the stuff that's happening in the world, or what about the recession that's right around the corner? Now, it's been right around the corner forever, but anyway, you get it. You get the idea. If it helps you sleep well at night. All right, guys, I appreciate you being here. And if you have any questions, like I say, hit me up in the comments. All right, see you later.